Good morning, investors. It is great to be back with you on another TipRanks webinar. My name is Ari Gutman. If you are brand new to the webinar series, I'm a customer success manager here at TipRanks. Now, I'm happy to see all the new faces, some faces that are returning. For those of you who are returning, I'm happy to see that we are all surviving the mayhem of the market, of course, with all of the banking crises that are happening right now. As we speak, just before I actually jumped on the webinar, I did see some news that was coming out of Credit Suisse in terms of the stock falling by roughly 20% this morning after one of its biggest backers had shared that they may no longer be able to provide assistance. So with that said, I want to go ahead and share the screen with all of you. Bear with me as I do just that. Okay, I hope this is a familiar page to everybody. It is the TipRanks homepage. We will go right to, actually, in our case today, Credit Suisse. Now, as I shared just this morning, Credit Suisse is actually down, and that is because of news that came from one of their biggest backers that assistance may not be on Credit Suisse's horizon. And I want to go, as I always do, about a year out and start to paint this picture for myself. Now, usually, in fair disclosure to each and every one of you, when I see red when it comes to a stock opportunity, that is actually a green flag for me because I want to buy stocks at low points. However, there's a lot of due diligence that goes into investing, especially when you are looking at a stock page that is in front of us now, like Credit Suisse here, that is down over 70% on the year. Let's start to look at some of our signals here. On our right-hand side, we have a TipRanks Smart Score of a 1. Now, for those of you familiar with our TipRanks tools and our scoring system of that Smart Score, an 8, 9, or a 10 based on 8 TipRanks factors means that the opportunity is likely to outperform the market over the longer term, so 12 plus months. But we have a TipRanks Smart Score of a 1 that is not looking too high. We can go down. We do see that there is some bullish blogger sentiment that would be interesting to check into. However, I'm looking more now at hedge fund activity to see a decrease. And typically what we have here is also insider opportunities to take a look at what insiders are doing. But overall here, not the prettiest looking stock analysis page to look into. Of course, we can go into the analyst forecasts, see what analysts are saying. I always recommend to scroll all the way down because you're going to get the best analysts covering the particular stock, in our case here, Credit Suisse. But all this is fine and dandy. The best tool that we have working in our favor, regardless of the stock opportunity in front of us, whether it's Credit Suisse, Apple, or any other stock that's out there, is the risk analysis tool. And it can be found on our left-hand side here, risk analysis. I want to give that a click. And I want to double down on the fact that weeks ago, we had the opportunity to take a look into Silicon Valley Bank's risk factors with this very tool. And these tools gave us everything we needed to know for the coming weeks before that collapse had happened. And if you were an investor doing your due diligence, perhaps you could have caught it. And if you were invested into the bank, you could have sold out. However, here we are on Credit Suisse's risk factors. To do your breakdown, we can see that 40% is going to come from financial and corporate risks. If we give that a click, we get a further breakdown of the finance and corporate risks. So again, another breakdown, again, with the biggest coming in from debt and financing in and of itself. Now, I won't go through each and every one of these risks, but as I scroll down here, you can see that we have the opportunity to dive into the newest risks. And we have our various risk categories that we can jump into and read when it comes to Credit Suisse. Now, the reason why this tool is incredibly powerful for every investor to utilize, and just for the emphasis here, I do want to pop back on the screen with everybody. As investors, we have a responsibility to not invest into numbers and ticker symbols. One of the best pieces of advice that my uncle, who was at Fidelity for over 25 years, had shared with me from a young age was to never look at stocks like their numbers and ticker symbols. And that rings true every single day that I open up my TipRanks app, that I'm looking into the market, that I'm analyzing stocks, and then when I'm about to make an investment. The reason being is because if I look at stocks as if they're tickers and numbers, I start to gamble. It gets really exciting. And investing, quite frankly, shouldn't be too exciting. It's a pretty boring sport, if you will, in the fact that you're getting invested into a company. And so what are you really doing? You're buying a piece of that company. You're taking ownership of that company. And I don't know about anyone else out there, but when I go to buy a new car, when I go to buy a new computer or a phone, I want to know every speck of detail that's going to be for that particular item before proceeding to transact. Buying stocks is no different. So if I have risk factors that are well known, I should be diving deep into those risk factors to understand what exactly I'm getting invested into as I'm about to essentially become what I like to say is the CEO or the CFO of my own life when I'm making these investment decisions. So investing into Credit Suisse right now, based on all the risk factors that if each and every one of us dove into, probably not the hottest idea. However, we can jump into other stocks, whether it's Apple or Microsoft, Procter & Gamble, Johnson & Johnson, these safer stocks, if you will, right now that are rated with higher TipRanks smart scores. They still have risk factors. And as an investor, as an owner of shares in a company, I should be diving deep into that risk factor tool to understand each factor that is a risk to the investment in and of itself. That is what a business owner does. That is what the executives at these companies are constantly doing day in and day out. There is no excuses for us as investors not to do the exact same thing. Now, I want to jump back on the TipRanks. Now, this particular tool that I want to dive into is underneath research tools. We're going to go on our left-hand side, and we have our Stock Screener tool. We'll click on Stock Screener. Now, right off the bat, we get this nice filtration system, if you will. And as you can see, we have the opportunity to begin organizing a stock watch list really for ourselves, whether it's with a company's market cap, price targets, dividends, smart scores, the sectors. And then across the board, we could dive into news sentiment, media buzz, blogger consensus, what hedge funds are doing and insiders are doing. Now, just for the sake of today's webinar, I want to go back to our economic backdrop right now. And to play it Sesame Street simple, the current economic backdrop that we are living in an environment with higher interest rates. That is definitely causing for pain across the board for businesses, regardless of the sector that they're in. Now, we can see that whether it was with the retail sales reports that are coming out, we could see that with the layoffs that are happening. Meta just again announced layoffs today. So a lot of the tech sector is being hit. Probably tech, given our economic environment, is not going to be the investments that I'm going to look into right now. If I'm going to begin to play a little bit more defensively, knowing that interest rates are going to cause some more pain in the stock market. Now, we also have inflation that is still high at 6%, as I mentioned. So companies are really faced with multiple battles throughout the remainder of 2023. Again, this brings me to me wanting to invest a little bit more defensively as a longer-term investor. Of course, I like to say that investing isn't always about having the best offense. Sometimes it really is about having a great defense. So without further ado here, let's just play it safe together as investors using our stock screener and start to filter out some of the stocks that may not be the best investments for me here in 2023. With that being said, I want to check off mega and large caps to make sure that the companies that I'm getting invested in, most likely they have these larger balance sheets, larger market capitalized companies out there. Now, for me, myself, I am a dividend investor, a longer-term investor, a value investor. So just for the sake of today's webinar, I want to have some fun with dividends here that are a little on the higher end, around 2.5%. Now, I'd like to go over to Smart Score because, again, TipRanks has this really neat Smart Score system here that stocks that are rated an 8, 9, or a 10 worth of a Smart Score means there's a high likelihood that those opportunities are going to outperform the market during the longer term. So again, 12 plus months. So I can keep to stocks that are rated a 10, and I go one more with stocks that are rated an 8 or a 9 worth of a TipRanks Smart Score. You can see my list has filtered out, but I want to play it safer by understanding the name of the game when it comes to sectors. Reason being is because not all sectors are equal when the economic environment is as it is. And as we are heading into an uncertain year here with a lot of the economic data that is coming out, some of the sectors I'd want to stray away from. Tech is one of them that I alluded to earlier, just based on the fact that as interest rates continue to rise, tech is really getting hit the hardest. But perhaps I want to play it safe with utilities. I could play it safe with healthcare, knowing that regardless of whether or not the economy is up, down, left, or right, anything in between, we're going to get companies like our Johnson & Johnson, Merck, Pfizer, a lot of these companies, they'll be the tried and true players that will be here long after, hopefully, 2023, regardless of the state of the market. And we'll go one more, say, with consumer goods, because we all know regardless of what happens economically, we are all running to the stores to pick up those personal care items, the items that we need in our daily lives. Now, we do have a beautiful list that has been filtered for us of all the companies that may meet my criteria that I have selected. But let's go a step further, because on TipRanks, that is exactly what we allow you to do. I want to make sure that the investments that I'm about to get invested into have some more positive signals. So when I utilize our stock screener, I want to see the stocks that have positive insider signals. That means insiders, whether it's the executive team or perhaps smart money or hedge funds that are making recent trades, and in our case, with a positive signal, buys on the company. Now I can go one to the right, and I can also select positivity here for hedge fund signals. And I have a list that's right in front of me. You can see now we have two stocks that this has been narrowed down to, Phillips 66 and Atmos Energy. Both of these are actually within the utility sector, but that makes a lot of sense. Based on the fact that our economic environment isn't so hot, we can dive right into, say, Atmos Energy here for today. Our stock analysis, we can go out and see how it's been performing. And we are actually up on the year nominally, a little over 1%, but heck, I'm not down on the year like most of the companies that we're seeing across the board right now. We have that TipRanks Smart Score of a 9. We can scroll down and we have across the board a lot of bullish signals when it comes to Atmos Energy. Now, again, this meets the criteria of an investment, longer term, a dividend investment, a very defensive play here, but we can see that there are insider transactions recently. We can see that investors across TipRanks have actually been favoring Atmos Energy. We can see that we also have an increase in hedge fund activity. Let's go a step further here just to show you all through our insider trading. As recent as yesterday, we have informative buys by a director of the company. Again, another favorable, incredibly positive and strong signal for me as an investor when I'm about to make an investment decision, to see that I have an insider here, a director that has been purchasing shares of his own company. That is a belief, a confidence that the future is bright here for Atmos Energy. And I say that based on the fact that I can safely assume that an insider, someone working at Atmos Energy, has more insights and knowledge at his or her fingertips than I do as the retail investor. Now, again, we can jump right into risk analysis as well, as that is another tool this week that we are highlighting. And before I would proceed to actually transact and invest into Atmos Energy, I would sit down and I would go through these risk factors just so I know exactly what I'm getting invested into, the risks that may come about from this particular investment. However, you can see just based on the fact that we jumped into our stock screener, that we started to filter out the stocks that may not perform so well during our economic environment that we're currently experiencing. We come to a stock like Atmos Energy. Now, by no means am I sharing with any of you to dive in on Atmos Energy right now and buy this stock. I'll join you back on the screen and share with you that I am sharing with each and every one of you that from where I sit and how I see it, based on all the economic reports that I read every morning, the economists that I follow, the CEOs that I typically listen into, whether it's our CEO, Doug McMillon at Walmart, Jamie Dimon over at JP Morgan Chase, or we have Fed Chair Powell himself, as of his latest commentary, sharing with us that the road ahead is going to be bumpy. I, as an investor, want to make sure I'm making the wisest possible investment decisions. How exactly do I do that? I dive into risk factors to get the risk analysis on a stock opportunity. I jump into insider activity to see how exactly insiders are trading in or out of their own position. I take a look at what smart money is doing, what hedge funds are doing, whether they're buying, whether they're selling. How are other investors investing? How do I foresee the economic environment in the coming 6 months, 12 months? Now, me personally, I do think it will be a bumpier road ahead. 2023 is really just getting started in terms of volatility. I do foresee some pain ahead, but I'm not scared in the slightest. Why? Because I have the tools that I need to do my due diligence. Now, I know today is a webinar for our basic users. That is all of you. And I want to share with you that the time is now. As we're getting a lot more volatility heading into the year, not just to buy TipRanks, but as investors, to pick up an investment toolkit that is your one-stop shop that allows you to do everything that you're going to need to do your due diligence on a stock. Now, it wouldn't be a TipRanks webinar without me sharing. We are sending you an email as we speak to take full advantage of the TipRanks tools that we have. Ladies and gentlemen, thank you so much for joining me today on today's webinar. I look forward to next week and having each and every one of you join me, hopefully on Monday for our premium and ultimate webinar, if not on Wednesday, as we roll into the Federal Reserve's blackout period and come up on the end of the month here of March. Thank you so much for joining me, and I'm looking forward to next week.